thank you, audience, for tuning into part one. I hope you really enjoy the action filled insights that we got from the M55 Capital team. So, without much ado, let's dive into part two and get more insights from the founders themselves. You mentioned a very important point about the token strategy being a part of the business model, which is something that I have seen lately that the token is not really required in most of the situations, but the founders deliberately put token as a part of the business model, mainly because no VC is ready to fund unless there is a token involved. And 99% of the times, the token price is not indicative of the business performance. Like the business may be fundamentally very good, generating revenues, have a very good community, but the token may not do well. So, how do you navigate this, and what is your advice to founders who are really wanting to launch a token where it's not required?
I mean, when you were asking earlier about who will be using the stable ecosystem, more like unbanked population, Latin America, Africa, Southeast Asia, or more institutionals. And that's the problem with industry, but it's a by design problem, is that we build tools for decentralization. In the end, it's still like, we still re-centralize it because, how to say, the rebel, like shaking the establishment, become the new establishment. So the same thing Guilain was answering, can be the institutional using mostly. But the original and a bit more pure ambition was to serve the unbanked with the stables. It's a bit of the same here. Is like who need a token, who doesn't need a token. For me, it's definitely part of a business model because we are looking from a financial perspective. And then should founder focus on only that? They should focus on that as well because we are serving any stakeholder. So it goes from the early VC, the team, to the users. I mean, users are incentivized to use the product. If VC incentive is getting down to zero, then there's no more incentive to use the product. Or the product needs to be priced, means it doesn't have any more value. Right. Incentive is not here and people are not willing to be paying themselves. They still need the reward. If not, they will not use the product. But it works in a way because the whole market is based on the asymmetry of information. I find the product, I create providing liquidity. I mean, me as a user, I bring liquidity, I bring velocity, I bring my user time, my play time on whatever protocol. I mean, I need to get rewarded for that. It's my way of being an investor. So it's more like a, in-kind investment from the retail market.
Right. So I think we are still in an era of play to earn and play and earn, because the more users interact with, say, platforms, it could be a gaming platform, it could be content streaming. The more you use the product, the more you get rewarded. And that is probably an incentive mechanism which gets users onto the Web3. It could be a way to adopt for Web2 users to adopt the Web3 technologies. Although let's not talk about the crazy onboarding process and everything that they need to get into, but I think incentivization, like you mentioned, is one of the pillars that would actually get a million users on board Web3. Now, you both have a very unique mix, because you come from TradFi, you come from crypto. Do you still prefer a safe plus token warrant? Because, safe is always a form of equity that is more traditional and more safe, I would say, in a way, as compared to tokens, which have a probability of getting dumped. So at M55, do you follow like a safe plus token warrant, or are you just focused more on token structure because it's a pure play Web3 issue?
Sure, we can do both, but you see, I mean, for me, there were like 3 phases. There was one phase when, when we started, we were doing like what we call now a SAFT, which at that time was like a future token contract, we didn't really know. And we was even pricing that in ETH, in Ethereum. So, I mean, we've done a long way since that period. And to answer the question straight is that what we focus on is if we wanted to do like pure PE, we'd do pure PE. It's in our management mandate, we could, but PE it goes with everything you... It's a balance. You want like some of the safety of traditional finance, but you also got the constraints. So it means like you're not liquid in token. I'm not talking about vesting or lockup. I'm talking about permission rights, drag along, tag along, ratchet clause. I mean, it's like a traditional mechanism that we don't want to have because we want to enjoy that speed of capital, being able to move from one position to another. You're on the cap table. You have to disclose who's on the cap table. There's no brokerage on that. So me, I would advise like to just do what is the standard for the compliance of your investor. In the end, it's always a soft. We can call it a safe plus token warrant. I mean, if we invest in a project which is early stage, or still talking about early stage, giving us equity, what does it worth the equity? How we can liquidate that equity, and who we're gonna buy on the who we're gonna find on the market to buy the equity. So some projects which have like a long-term horizon make sense to have a safe plus token warrant. If not, that's what we call a legal fiction. It's a legal fiction. The equity is just like a little legal frame, regulatory frame to put the equity, which give you a portion of the token release.
Right. So I've seen a lot of projects currently within the fintech neobank vertical, which are integrating Web3, but technically they do not have a lot of token element to play, right? So in that case, probably equity would make sense. But like you mentioned, dilution of equity is a big problem because then it's probably on the investors themselves to go and find a secondary buyer for your equity. And it has to go through a long phase, like even from pre-seed to IPO or to acquisition is not about a couple of years. It would take like half a decade to be very optimistic. So that's a lot of capital that gets locked in the way. And that's something that, I really tell a lot of founders that you really need to be at speed because you can't be building at a very slow pace because at the end your capital is blocked, and we also invest because we want a 10x 20x exit on equity at least. So that is a very valid point that you mentioned.
Yeah, and to bounce on that is the thing is that I mean the job is speed of capital,
Yeah.
like moving from one deal to another. Problem with this industry specifically is that the opportunity cost of not being in the market is too high, way too high. I mean, if you're stuck in a deal with USDT, even if the deal delivers like 2-3x after 2 years, I mean, what's happening on the market? You could make that with almost like zero drawdown risk.
Right, right. Yeah, I completely agree on that point. And another point that, is that we see a lot of valuation gaps as well in the Web3 space, especially for the VCs. Like, since you come from a traditional, and even a part of you comes from traditional, we are used to a lot of financial models, multiples, industry standards. How is the company growing? We have a proper structured data room, and there is a set process of how investing in Web2 works, the traditional models. But in Web3, everything is just so uncertain because during the bull market you get projects which are coming out at an insane valuation, say 60 million, 80 million, when they just have a prototype ready, they do not have any community members. But from a VC perspective, even though it's a good model, investing in a 60 million would not make a lot of sense because your return on capital is not going to be that high. So how do you juggle between the valuation gap that you see in the Web3 space? And do you really think that Web3 needs to go the Web2 way in terms of investing more from a VC perspective?
Yeah, I think Web3 is going the Web 2 way, but like for not for the right reason. It's going the Web 2 way to be able to capture the liquidity from the Web 2 new investor, I mean a new liquidity provider in the industry, which are the wrong reason. I mean they should go because it's best practices. That should be like a legit reason. Just going to seduce the liquidity is I think not too healthy as a reason. But well, I mean we can say the same thing is that like all the job is based on discontinuation, speed of capital. If it's not going fast, if you miss the momentum, if you fight against the train, it's done. I mean, the product is already obsolete. We were talking about the mission before. I mean, you can scrap it and move to the next one. And it's okay. I mean, that's the job of VC. I mean, if VC wanted to do like a pension fund, they would do pension fund. If they want to bet like to bet at 1 on 10 or 1 on 20, gonna make a 200x. Still, we're not in the VC ratio. And all are profitable except like a 30% write-off. That's fine. That's the risk they take. And so it's all about speed, catching the momentum, and never fighting against the trend. Fighting against the trend is just like burning cash flow for no reason. And then about the valuation, yeah. I mean, yes, there are best practices in VC, but I mean, what does that work for multiple? Multiple in private market, which is like from few deals that have been disclosed? Do we really know the real valuation? Do we really know like the mechanism within the deal that, it's like the TechCrunch press release when you see 20 million, yeah, it's maybe 20 million, 30, 50. Maybe it's like 5 tranches, maybe it's 5 tranches under KPI, maybe like really uncertain KPI like regulation based or patent delivery. So it's the same thing. And what we see now in crypto is that we used to do like SAFT, like basic SAFT. Then we started with vesting, with a lockup. And then now we are starting with like a more sophisticated mechanism, like team founders lockup and vesting based on KPI, which like keep the commitment till the end. I think that's more this way we should do than just like doing how to say, doing like a rushy copycat of what are the best practices in the VC. I think it's more about like appropriating like some existing mechanism and making it fit to the industry.
Yeah, I think what you just said, that having a team vesting is very important because you want to ensure that the founders are still motivated enough after the TG to keep building their business. A lot of founders get crazy unlocks at TG, which means that they're not motivated enough because suddenly they've made a lot of money, and the vesting is something that definitely helps. So, is that a part of the term sheet that you negotiate with the founders in terms of this is what the tokenomics should look like in terms of the team and the advisory vesting?
I mean, definitely for us, it could even be a deal breaker. But I was not talking about like time-based vesting. I was talking time-based vesting is, for example, what we've done like since almost third cycle now. Is like KPI-based vesting, which is not because like it's 12 months and you've been able to keeping afloat the price of a token that you can get the token release. I mean, you still needed to deliver some stuff. So, I mean, we move from something where we're like like a best will obligation for founders. And now we're moving to an area where like founders need to deliver. It's not about like you deliver a token and you're done. You deliver a token, you deliver a KPI, daily active user, liquidity threshold, etc. Then we reduce the uncertainty of the pitfall of founders slowly exiting the project. We don't reduce the uncertainty of the market, of course, but at least it's like one uncertainty parameter that is solved like that. KPI-based vesting.
So, coming to you, do you have any points to add on this? And what was one shock that you saw when you entered into the crypto industry that made you be like, okay, this is not how it used to work in the TradFi?
Speed. The layers of difficulties that in trad we put that exploded. Yeah, it's amazing when you arrive in the crypto world how everything is quick, and that's my biggest shock, and that's why I got interested.
So, is that something you really love, that crypto moves so fast, or so you like the crypto world more than the TradFi bit?
Yes.
Because I think in TradFi it takes like months and sometimes years for the deals to close. The amount of paperwork, the amount of lawyer fees that you need to actually put in terms of getting a deal finalized, finding a buyer, it's way too difficult. And sometimes at the end, after the due diligence phase, also there are a lot of deals that pop out. So technically, you wasted months for a deal not happening.
But let's not forget that what I see now in crypto used to be the same in trad in the 70s. We could do anything. We could invest very quickly. We could so it's just in the longer term, the trad finance became more and more difficult. They made it more difficult, and I think that's what I liked about crypto, is that we're getting back to simple, fast investment.
But do you think that crypto is still in a very beginner stage? Like you mentioned, you're seeing in crypto what you saw in the 1970s. Do you think crypto will also mature to a stage wherein it would be like where TradFi is now?
It has to mature, but and it's still early, but that's normal. There's a long way to go with crypto, but it will change slowly, but hopefully not doing the same error that we did as the TradFi did, like putting too much layers.
It will come. I mean, you will still have like mainly, I would say, like two different type of audiences to serve. which is like to attract new liquidity from out of the market, which is, I mean, crypto is still like a tiny epsilon in the financial market. To attract the new liquidity, it will have to be more compliant, in the frame of a regulatory, whichever jurisdiction we're talking with, lowering the risk, the uncertainty on the market. Okay, all that is coming. That's a way to attract the liquidity. But one way is that like the room for flexibility we have in decentralization, which okay, whichever sex has to comply with a jurisdiction here. I mean, we still have decentralized product, and there will be even maybe a dichotomy in decentralized product, like compliant decentralized product, maybe with even a legal entity behind, and like absolutely freestyle decentralized, as we knew since ever, and which will still be on the market. So I think like for each audience, there would be a way. We are heading for that to attract the money coming from institutionals, as we were just saying, Guillaume, but there would still be a market for, I mean, crypto native as a one we kind of grew up with in the industry.
Yeah, so I think the noise that is surrounding crypto needs to die down, and we need to focus more on the other pillars of crypto, which is decentralization, regulatory clarity, for it to become more mature and adoptable by institutions and retail worldwide. Now, one thing that I would also like to know is that it's very difficult to source deals in the Web3 space, and we've always rely more on, say, a warm introduction, say from a fellow VC or from a fellow builder whom you've invested in, to get good deal flow. So what is your best strategy as a VC? What do you think is a good deal flow? Do you think that attending events or probably hackathons is also a good way of getting deal flow? Or do you have any other narrative, like being in a VC syndicate would also provide access to a lot of good deals, which the syndicate is investing in? What is your way of navigating, say, to the tier one deals? We are not talking about the normal, small projects here. I'm talking about projects which could probably be the next unicorn. How do you find those deals?
Yeah, I would say like there are maybe only one way to do is that like you get people in good deals, they get you in good deals themselves. So it's like a kind of a bounce back favor, or like how do you say, community of interest. It can go from any level. I mean, now we are talking about like top tier, but you can scale down to any type of investment ticket. If you are like a individual getting into crypto, you can join a syndicate pool, you can join access to a primary market, providing that the primary market is still profitable.
Yeah.
Then you can go to syndicate pools, you can go to club deals. There are like so many forms: unregulated fund, private pool, blind pool, syndicate pool. But the best way is like that is, I mean, the curation is from people you estimate that they have like a deep understanding of not only the tech, but the tech and the market dynamics. Tech is one thing, market dynamic is more a money game. Once you pass that threshold from all these people, it's more about like, okay, who's been putting who in which deal.
I think what you mentioned is correct, because you're in Web3, your network is your net worth. So if you want to grow in terms of your net worth, you need to grow your network, and having the right people around you makes a lot of difference, more from a VC perspective, but even from the builder's perspective.
Absolutely, from the builders. I mean, a lot of investors now are former builders, successful or not successful. I mean, you can be good at investing. There's no real correlation, but most of the investors are former builders, which is really important. So I understand like people in front as well. Yeah, I would say like that. And then you see people portfolio, because like some people look like pretty extravagant in the industry, but they spotted things early. They felt something. So there's a bit of something which is more like sentimental than rational. Sometimes you are talking about like going to event. I'm assuming that you try to get something for the funders that we have in the cohort. I mean, definitely, you want to get shortcut and don't wait for any intro, just go straight to the event. And when there's still this kind of alchemy, sometimes you get some crush on the founders, founder get crush on investors, and can pop up something, can cook up something out of it.
Right. So in the recent past, we've seen a lot of VCs pop up. Now, that could be like crypto VCs, it could be an angel investing, but a lot of TradFi funds, like if you say even Sequoia Capital and Tiger Global, is coming on to the crypto space. So, how do you see the space evolving more from the VC perspective? Do you think that crypto VCs are going to dominate, or probably blockchain VCs such as ours, XVC Tech, is going to lead the narrative? Or do you think like everyone needs to come together and build the VC world and make a difference?
I think we all come together because, I mean, once again, the market is like still at the early stage. I mean, proportionally compared to liquidity on the market, the private market growing, and which is expected to grow a lot in the next few years. There's definitely like space for everyone. Then there's space for everyone because your job as an investor is to match liquidity from one side for the LP root ratio, project issuer from the other side that you've been creating. So there's definitely space for everyone and all type of project. If we talk about like the I'd say top tier Web2 VC coming to industry, I mean they're still gonna invest in like specific projects which have to go for DD, full of compliance, maybe even like able to generate revenue with a different perspective and timeline. But it's all about like I mean it's still a money market. It has to move. So who's serving the other audience? So I think to each investor its own project, to each founder his fitting type of VC. And so I think yeah, there's space for everyone, and the how to say the spectrum of ticket size valuation, token price strategy, time horizon, and any other investment parameters you can imagine has to be served. So we need that full spectrum.
Right. So what you mentioned is very is perfectly on point, that a lot of VCs, probably the traditional VCs, would focus more on the equity investments and focusing on a different narrative as compared to the Web3 VCs who are used to like quick narratives change and quick money in return, right? So there is a space for everyone in the VC circle. Now, so you've been in UAE for since 19.
1976. No, no, you're getting a big smile on me when we're talking about the UAE. It's such an amazing region. What they've done for the last 50 years is incredible. In every sector, everywhere they get their mind into it, it's a success. And one of the reasons is their fast decision. I mean, something very different from tech, but when they decided a few years ago to put the weekends from Saturday and Sunday from Friday to Saturday, it took them a month. In France, just by if you want to change the winter or summer hours, they can't decide. It's been 30 years. Here, everything is fast. If they agree on something, they do it, and they do it well. They bring the right person, and they make it happen. So that's very important for me. And I like the people. I think what makes a region incredible is also the people here. Even though there is a lot of expat, the Emirati and the local are so proud and pushing their country that makes it an incredible place to work, to live. And something very new that we didn't have a few years ago, people would come for 2 or 3 years to work and then go back to their country. And now it's not the case anymore. People want to stay. People will want to retire. I'm French, 100% French, but home for me is the UAE.
Is the UAE. Wow. That's so. I was on a podcast with Gabriel from 50x Capital, and he mentioned a very interesting analogy about UAE and about Web3. So, UAE was actually a desert, so you would know when in the 1970s, 80s, 90s. But uh, um, the leadership had a vision of making it a very thriving city, and that's how he developed everything. So what we need to focus on, even as a Web3, comparing it with the UAE, is that you need to have a good community. You need to personalize everything for every type of community member that you have. You need to pivot, because UAE was low on oil reserves, but now it's become a very thriving tourist destination. So pivot, like we were talking about, is also something very important. So UAE is actually something that we should take in as take as an example for the Web3, how it turned from, say, an early stage desert to a very thriving economy right now, and just self-sustainable and just growing and growing and growing, and it's just attracting people on its own without doing anything. Everyone from every single part of the world wants to come to the UAE, wants to build here, wants to stay here, thrive here, and probably make it their base, like how you have done, sir. So this is something that is very important: how to build a community, how to pivot, how to make people your loyal customers in the Web3 space, like how we are loyal to the UAE here. So I really loved this analogy, and I keep giving it to a lot of projects that I say that learn from the UAE, learn from the leadership team who has built into something that was there nothing to what it is now.
No, and they're doing one thing which is very important is that we have that thing, that saying in French, that when a lot of people, and I've seen that also in founders, they do their bicycle with their head down and going fast, and they never put their head up and see, okay, where am I and where do I want to go? And that's what UAE has done, is that they're going fast, but they've been looking, they've been listening, they've been learning. And that's why the country is doing so well, the region is doing so well. And as you said, they pivot so quickly. I mean, they have, I mean, Abu Dhabi has oil, but Dubai hasn't, and some other Emirates also have. But they know where they want to go and what they want to achieve. And a few years ago, when I was seeing a lot of construction around Dubai, they were empty, and I was saying to myself, "My God, they're building so much, and no one is there." But actually, they were one step ahead, and they are now they are still building, because what they built a few years ago is already full. And that's incredible. And you can, we're very lucky. I think a lot of expat forget how lucky we are to live in this region, and what this region has given to us.
Yes.
So I agree with what you said for the way you should look at the way the UAE is dealing their futures.
Yes. So since UAE is pretty forward thinking, a lot of and crypto friendly, I would say, a lot of these Web3 projects want to set up shop here. Now we just don't stop at Web3. UAE also wants to become the global AI capital by 2031. So it's become very visionary in terms of how they want to position themselves, not just as a tourist destination, but as a global business hub for crypto and AI projects. So, is this something that you also recommend to your founders, that hey, why don't you go and set up shop in the UAE? It's very crypto friendly. The regulations are coming out, WARA, ADGM, DFSA, all of them are actually setting up, going one step ahead from probably a lot of other countries around the world. So, do you feel safe when your projects are based out of the UAE?
Definitely, yeah. I
Yes.
mean, that's first, I would say it's a kind of like a no-brainer to come for founders. For us as vetting, definitely. I mean, the framework is here. The how to say, accessible regulation is here. You got all the facilities. I mean, you go from one free zone to another, you can see all the regulators, all accessible. It's super fast, and it's done. I mean, people did it. We were talking about Ahmed, I think, from RAC, which was in the panel. Uh, you can go to any regulator. I think it's like one of the best jurisdiction I've seen. I mean, it's not like claiming to be crypto friendly. It is for real. You can launch, you can operate, and it's definitely like maybe the best playground for ambitious crypto founders.
So yeah, I think UAE is definitely the place to be for crypto, and probably US will see how it unfolds within the next couple of years. But UAE and US seem the right fit as of now for crypto. I want some kind of VC insights from you. So have you ever invested in a company which has been struggling a lot, probably down the drain, and the founder doesn't know what to do, he's lost a lot of motivation, but as a VC you gave a lot of support, and you got the founder out and motivated him, and you know the project is thriving right now? Because a lot of these early stage projects, even from what we see, they are very motivated at the start, but during the way, if they are not able to raise further funding, if they are not getting users, if they are not getting any kind of traction, they lose all the motivation and then they probably go on to something else. So I want to know an instance wherein you helped a project that was not doing well and got them up and
I mean, first point is that it may have happened that we get more involved in supporting some funders, but we cannot do the funder's job, which is like the willpower. I mean, we can give resources, we can intro, we can open the book for them to choose like who to meet. We can set them up with some people, put them in the under the spotlight a bit more. But one thing you can never do is like giving the willpower. I mean, either they have, either they don't. And plus, I don't think it's our job to push someone who doesn't feel. I mean, you can push someone to go and raise, boost him, intro him, then he's gonna go and raise. But if he doesn't have the willpower, it's just gonna get like a bigger catastrophe at scale for him. So it's better to withdraw, wrap up. It's okay to wind up the thing, okay, move to the next one. It's okay. I mean, markets are really cyclical, and people energy is really cyclical as well. So we just should respect it, I think. And where we've been pretty lucky is that it doesn't happen that much when people. I mean, it's also a big knowledge from experience from founders to think, okay, it's time to wrap up. It's done. There's no hope. It's okay. You went down. You move to the next one, and that's why I really like to work with, as a, like not first-time founders because they got this ability to move to the next step, readapt, reshape the thing, reshape to the market. You miss the momentum, it's okay, move to the next one. And it's a job founder to experiment fast, deliver fast. It doesn't work. It going by iteration, by implementation, and going from one iteration to another. I think that's one of the best quality from founders. Founders who are able to move by iteration are not falling in the pitfall of being desperate. They know there's always a next step or a parameter to adjust.
And I think it's important also for investors like us.
Mhm.
It's the same thing. You invest in the project, you like it, you push it. But if you see very quickly that it won't go, just go out. And
And when you need to write down, you need to write down.
Yeah.
I mean,
we
it's okay. It's part of the job. It's part of the job for investors.
Mm.
It's part of the job for founders.
Okay, founders. So we've got really good advice from the two panelists here. Always try till you succeed. Don't be afraid of failure and keep moving on, keep pivoting until you reach your goal. Don't be scared of anything. Thank you so much for being a part of the podcast. It was a really pleasure speaking with you and hosting you in our Dubai office. So, the links to M55 Capital will be given in the caption below. Please do like, share, and subscribe to them. And thank you for tuning in to another episode of XVC Tech Insights. Until next time, keep building, keep innovating. Signing off. Thank you so much.